Ladies and gentlemen, welcome back to the channel. We have a little bit different of a setup here for you today on the way to get my daughter. It's a long car ride, and I figured why not try to make a video. So this is really improvised here, and hopefully the sound is not too bad. This car is not very soundproof from the road conditions. Nonetheless, we have some pretty big things. And apparently a deer just tried to make its last day on this planet in front of the vehicle. So yeah, let's continue on. We do have some pretty big things to go over here in this video. We obviously had retail sales today, and that's the last big catalyst we have heading into tomorrow, which tomorrow starts a brand new policy era for the Fed. But if you're an economist like me or strategist in markets or just investor in general, this kind of feels like Christmas when you're like 10, right? It's something different. It's a change. We're not going back to where we were over the past couple of years, and there's going to be a lot of opportunities. So if you like money, then tomorrow is a big day for you. Now, with that said, we got retail sales today. Retail sales came in on the good side, believe it or not. But what's actually interesting is the odds of a 50 basis point cut are basically unchanged. And there's a lot of mixed opinions on this. So retail sales showed an unexpected increase in August. Okay, let's establish something here. I know a lot of Wall Street's gonna say, oh, soft landing, we're not heading for a recession. The fact of the matter is the government data is either botched in and of itself, it's inaccurate, or it's highly delayed, because what we're seeing on the ground does not reflect a very strong economy. And then you can obviously differentiate between notional value, right? Obviously retail sales are higher on a notional value basis because of inflation, okay? Volumes are still down a lot. Like, people are getting less burritos, they're getting less TVs, they're getting less cars, they're getting less of all of these things, but prices may be higher on those items, which makes retail sales look a little bit more impressive. So keep that in mind. I do think the next couple of months, you're probably gonna see retail sales slowed down a bit. But the initial estimate for all sales showed an increase of 0.1% on the month, down sharply from the upwardly revised gain of 2.3% in July, but better than the Dow Jones forecast for a decline of 0.2%. Excluding autos, sales increased 0.1%, slightly lower than the 0.2% consensus estimate. The retail sales numbers are adjusted for seasonal factors, but not inflation. Now, so seasonal factors, there's a lot of tricks that get used for these seasonal adjustments. Without getting into it too much, Wall Street likes these numbers, okay? They are better than expected, and certain categories are better than others. Like spending rose 1.7% for miscellaneous stores and 1.4% for online retailers. With oil prices falling, gas stations saw a 1.2% decline in receipts, while sales at clothing and furniture stores fell 0.7% each. Now, Nick Timmerhouse is giving us his view of retail sales today, and really the 25 or 50 basis point argument for the Fed meeting tomorrow. He says the Fed faces a finely balanced set of considerations over whether to cut 25 or 50 basis points at its meeting that begins today. The case for 50 comes down to what Fed officials call risk management, but what might be thought of as a regret minimization. Per former Dallas Fed President Rob Kaplan, if you cut 50 here and you think the Fed will need to cut again after that, you are unlikely to regret such a cut, even if the economy chugs along between now and your next meeting. But if you cut 25 and things worsen a lot in the coming weeks, you feel bigger regret, as you'll be behind the curve. The case for 25 boils down to some combination of: one, the process issues. Example, 50 will signal something more urgent. There's an election soon. Communications were not explicit enough about 50 in the run-up to this meeting. 2, a view that the economy is doing just fine and will continue to do so with more gradual reductions. And 3, that because financial conditions are easy, in part because markets expect the Fed to deliver a string of cuts, igniting risk assets could make it harder to finish the inflation fight. So there really is pros and cons to both 25 or 50 basis points. As Nick Timiraos says here, 50 basis points could spark more fears that maybe the Fed's behind the curve already, maybe they're signaling more unemployment to come, maybe the economy is going to get worse. But then if you only cut 25, you're also risking some of those same problems, but maybe you will get behind the curve. So both arguments can have a very good or bad outcome for stocks. And that's why I think tomorrow is going to be so interesting, because nobody really knows what's going to happen. Now, Nick Timiraos does go on to say a final note about the process. When articles say this is a close call, this can be interpreted to mean that it's a matter of counting votes. And if the people who support 25 outnumber the people who support 50, then that's the way it goes. That's the wrong way to think about this for a few reasons. First, there are likely to be some people who feel more strongly about one but can live with the other, and vice versa. There may be some in between who are legitimately uncertain about what to do, and there may be others with very strong opinions. Any dissent is possible for a cut of either magnitude. In the current circumstance, a close call doesn't mean a 5-4 Supreme Court decision close. It means that there's a lot of uncertainty about what's the right thing to do. In the end, Powell can probably build a reasonable consensus around either, says William English, the former director of the Monetary Affairs Division at the board. So he's saying Powell, he could probably lean the board into either direction. That's what makes it so interesting, because if you look at the Fed monitor tool, Fed rate monitor tool that is, there's a 62% chance of a 50 basis point cut tomorrow. Only a 38% chance of a 25 basis point cut. If we head into tomorrow with these same odds, if we don't get another hit piece from Nick Timiraos, there's no, messaging tools used by the Fed will cut 50 basis points. Now, as I have said before, I don't think that is going to be a positive for markets. In fact, I don't really think a 25 basis point cut is going to be positive for markets either, but markets might see that as a more positive outcome than a 50 basis point cut. And what's even more interesting about all of this is if you look at different various opinions here, people are still widely expecting a 25 basis point cut. Like this, the CNBC Fed survey out today says the Fed to cut rates by a quarter point with a soft landing expected. So what happens if you cut 50? Are people actually expecting 50, or is just the bond market pricing in 50? And how are people and algorithms going to react to a 50 basis point cut? It's a tough call. Now, stocks today are hitting a new all-time high. Okay, I think the odds now of a sell the news event coming tomorrow are higher than what they were yesterday and the day before and the day before that. You've had many green days now in a row heading into this Fed meeting. You are on 1, 2, 3, 4, 5, 6, 7 green days in a row heading into tomorrow. What do you think logically is going to happen? Put on your risk to reward cap here and just think about it, right? You're tomorrow would be 8 days in a row if we close green. It's possible that we do that, but what about the rest of this week? It's highly unlikely that we just continue higher. Now, I will also point you to what happened in 2019 when the Fed started cutting rates the first time by 25 basis points. That was, yes, very politically motivated. Trump at the time said he was going to fire Powell if he didn't start to cut rates, and rates were at 2.5%. Like, they were not 5.25% where they are today. Nonetheless, the Fed cut rates 25 basis points August 1st, 2019, when markets were at an all-time high at the time. And let me show you what happened. Over the next 4 days, markets sold off 7%. That was here. And you were kind of holding up at those levels heading into the cut at all-time highs. And then you fell 7% in 4 trading days. Markets ultimately bounced, came back down, bounced around for a while, rallied higher, came back down, and then you had a multi-month 21% rally to end out the year and to start 2020 before the Rona hit, and then the rest was history. Now this time around, it's a little different because, well, I should say, the economy in 2019 and today is very similar, right? In 2019, there were a lot of concerns that we were going to go into a recession. The yield curve had uninverted. We never really got to see what was going to happen because the Rona came. Some people say, like myself, the bond market knew ahead of time that the Rona was coming. When you're dealing with the bond market and so much capital, they tend to know things before markets do, okay? And that's what's so scary right now. The bond market pricing in so many cuts from the Fed is literally pricing in a recession. Markets don't want to realize that, and that's fine. Eventually that will probably come around to be realized if the bond market is correct. But nonetheless, I think it's going to be very hard to just skate by and continue to go higher in markets. We have an election coming this time around, and that's what's really different from 2019 until now, is the Fed's cutting right before the election, which normally you get some kind of election correction in October. Perhaps after this Fed meeting, after we get the first long-awaited cut, markets start to look forward to the next thing, which, yes, is going to be each point of economic data, whether or not we are slipping into a recession, but also the election. Whether you're thinking about the Trump tariffs or whether you're thinking about the Kamala Harris raising the corporate tax rate, both of those are negative for markets. Both of those are negative for EPS estimates for 2025. One might be better than the other perhaps, but they're still both negative. So no matter who is projected to win, you still will have this uncertainty and this negative precedence around the election. And I think that is another big risk that markets need to couple with. And then last but not least, with all of these risks, the Fed starting to cut rates, potentially going into recession, the election, Q3 earnings starting up here in the next couple of weeks, earnings estimates for 2025 are still sitting at all-time highs. None of this has actually been priced into markets at all. No recession risk has been priced in. No election risk has been priced in. No downside risk to earnings estimates have been priced in, and this is all a risk from now until the end of this year and could come to a head after the Fed cuts rates for the first time. We will talk about this a little bit more as well in the next video, specifically what I'm expecting for equities, how low I think markets could go if we do get a sell the news event, and where you want to be positioned if we actually get a rally upon the first Fed cut. Because let me just tell you right now, I don't think big tech's going to do well, and I think other areas could do exceptionally well in the bullish scenario. It does become hard to kind of fathom with the markets up 7 days in a row. Tomorrow would be 8 days. If the day after that is green, it would be 9 days. That just becomes too long of a good stretch, if you will. So I do think the odds are to the downside that markets fall rather than the upside. But nonetheless, Tesla stock today is really taking that momentum with stride, up 2.34% today. We do have some news to cover in this video. He says, quote, "We want to avoid a trade conflict with spiraling tariffs that ultimately harms both sides at all costs." So basically, they don't want to ignite a trade war, something that did cause markets to fall about 20% in December of 2018, which is something you probably want to avoid at this point. Another wave of V12.5.2.1 FSD went out a few hours ago while we were out driving. A handful of other accounts did a great job sharing this news. This is the second wave in a single day and has included additional Hardware 3 vehicles. And this may be surprising to you, but we actually got a positive Tesla headline from Jalopnik that says Tesla's Cybertruck is kicking every EV truck's ass in sales. This does follow the news yesterday that was the Cybertruck is outselling all other EV trucks combined, or very close to doing so. And this is also some pretty big news. The Cybertruck will start deliveries in Canada likely by the end of October. Tesla North America shares this post about FSD and how this individual did a 250-mile drive with 0 disengagements, and they say, and it will get better. Mohammed A.L. Arian on X says, as detailed in the Bloomberg tables below, this morning's U.S. economic data point to a resilient economy that continues to overcome a host of headwinds. The retail sales numbers are consistent with a view that the considerable economic pressures on lower income households are not impacting the level of overall consumption. The industrial production data show the U.S. is doing better than expected by all the surveyed forecasters. Interestingly, the data releases only marginally impacted Fed rate expectations that according to market pricing, still favor a 50 basis point cut tomorrow rather than 25 basis points. Heisenberg on X writes, if we close very green today and we get another pump tomorrow off FOMC, I gotta imagine a sell the news / profit taking event. Option activity in Tesla stock today is very positive. You have seen 23 different trades totaling $10.19 million with a positive order value of 91%. Tesla's short interest of free float sits at 2.86% with $18.01 billion currently sold short. You do have a lot of short covering as well today. Almost 500,000 shares are being covered on, and only about 109,000 shares are actually being sold short. So let me know what you think about this information down below in the comments section. I do believe we're at a very important moment in time. You really want to look at your portfolios and evaluate what you're holding, what's going to benefit from rate cuts. Are you willing to hold some of these stocks that may not benefit as much from rate cuts, like big tech? And really give your portfolio a look heading into tomorrow. Now, in the next video coming out at 8 p.m. tonight, we will go over exactly that, what will benefit, what will not benefit from rate cuts, why I hold a lot of cash right now, why I see the downside risks to markets as much greater than the upside risks, but the way that I am still keeping skin in the game, if you will, to be able to participate if I am wrong. You want to position yourself, long story short, to benefit or to win, whether you are right or wrong, okay? I don't think I will be wrong, but if I am wrong, I will still benefit from it. Nonetheless, look forward to joining you guys at 8 p.m. Eastern Standard Time tonight for that video. You guys have a great rest of your day, and I will see you in the next one.